Hey there, welcome back to Demystifying Money. I'm Misty Lynch, certified financial planner, and I'm here to guide you through the financial roller coaster that is going on globally right now. So, I know it's been all over the news, but I wanted to talk today about the latest updates on, the tariffs and the market and what this could mean for small business owners, what this could mean for everybody regarding their expenses and their budget, and some things you could do if taking no action feels bad right now. So we're going to talk about the tariffs. I think that it's important to understand that it does feel like the sky is falling sometimes, especially when we see these headlines. We look at our 401k balances or our investments, and we see these sharp declines. And I think this is going to impact everybody, no matter if you have money invested in the stock market, if you're not there yet and you're still, budgeting and you're still making income and you're supporting your family and your lifestyle, we're all going to feel this. So this is going to trickle down from big businesses, small business, pretty much everywhere. So, and when I talk about small businesses, I think that this is important to know that 99% of all US businesses um, employ less than 500 people. And, we're 47% of the private workforce. So almost half of the working population depends on companies that are far more vulnerable to rising costs of supplies and goods and economic shifts than other, larger companies. So when tariffs go up, inflation sticks around, market gets shaky. It's not just a big business story. It's a small business, it's a family budget, and it's a real life story too. So to backpedal a little bit, what's going on as of today, and I'm recording this right now on April 10th. So the U.S. announced tariffs some as high as 125% on key imports, including electronic vehicles, semiconductors, and medical supplies from China. This move is done to protect American industries and reduce reliance on manufacturing. According to, the White House's press conferences, what they're saying. And China has retaliated with their own tariffs and trade restrictions, including 84% on US goods and the blacklisting of 18 US companies. So to understand the ripple effect of this, in 2024, the US imported 427 billion in goods from China and exported around 148 billion back. So China remains one of our largest trading partners. So any disruption in that flow is going to create waves. And so large corporations may be able to absorb these shocks with international teams and alternate supply chains, but small businesses might not be able to be so lucky. They often deal with one supplier, they have tight margins, and they can't easily pass down costs. So this is why it's crucial to understand why policies like tariffs are going to show up in everyday ways at the store, in your budget, and in your investment accounts. So one of the things that's important to think about when it comes to the investment accounts, though, is market corrections. And with this kind of global tension, it's very easy to get nervous, and that's going to show up. Those nerves show up in volatility, really for investors, for corporations. We're going to see things as far as what comes out with earnings reports. So I want to break down what a market correction is. It's a drop of more than 10% from a recent market high. So since 1974, there's been over 20 corrections. On average, they happen every 1 year, every 1.5 to 2 years. And the good news is they typically recover within 3 to 4 months. We saw a very sharp recovery yesterday, but granted, when we are going from a high and we go down 20% and back up 10%, we are still coming down from that low number. So we still have some room to go up before we hit where we started. So it's easy to feel anxious when you're seeing that. But it's important to remember that even though there's always different circumstances, there's always different um, elected officials, there's always different, different reasons, the actual correction itself is not unusual, and it's nothing that we haven't seen before. And the market never goes up in a straight line. So it's important to stay invested. If you don't need to take out investments right now, if you are panicking and trying to sell, I mean, it is usually more important to stay invested and wait for the recovery. Now, I will say I know that feels horrible. And if you're hearing from your financial advisor, just stay in there, it's fine, and they're dismissing your fears, I do think there are some real important things that you should be talking about with them. One of them could be your actual risk tolerance. Everybody can be aggressive when we feel like the sky's the limit. We have 20% returns, 20% growth 2 years in a row. It's very easy. But if you feel like seeing these declines makes you feel terrified, nauseous, if you don't believe that this is a part of it, or this is a buying opportunity, or this is a normal part of business, or if you're closer to retirement than when you first started investing, when you were more aggressive, but now you're looking at this and the time to recover doesn't feel the same, then it is important to think about maybe adjusting, your risk level and potentially rebalancing your investments so that you do perhaps have some more diversification in your account. So it's just important to think about that as, as an investor, but also if you can stay invested, a few other things that you can do to take action in times like this include looking at your cash flow, your emergency fund. We typically recommend 3 to 6 months in a high yield savings to kind of keep you from having to sell investments during a dip. You might feel like that's not enough. Maybe 6 to 12 months feels more comfortable for you. You might wonder if that's a wasted opportunity, if that's too much cash on the sidelines, but everybody feels differently. I don't think there's a perfect right number for people. I talk to couples all the time where one wants a higher amount in cash and one wants it all invested. And usually we could come to kind of a common ground and figure out maybe we have some of those money invested more conservatively than others, but it doesn't all have to be treated the exact same way. But having that bucket of high yield savings for emergency funds can be very helpful. And now is the time to look at your budget. Tariffs and inflation can make everyday living expenses more expensive for everyone. So it could be a good time to actually trim, reprioritize. And I will say this, I actually added to my budget because I was looking at it, and right now, this is a stressful time for all of us and myself included. And so I wasn't spending any budget on a gym. I'd given those all up. I hadn't rejoined since COVID, and I was really thinking about mental health wise, like what am I missing right now? What do I need more of? Now, that doesn't mean that like everything has to get cut. Sometimes we need to cut some things, and sometimes we might need to bring some things in. Sometimes we might need to just reevaluate our personal priorities. And this is something that we should do all the time and find some space for the things that are going to keep us healthy, keep us safe, keep us protected. So that might mean increasing things like your insurance or reviewing things that might not, it might feel like you have to cut, but maybe there's some things that you need to bring in. Maybe there's some things you need to reprioritize and pay more attention to in order to make sure that you could still show up as fully as yourself, as a parent, as a boss, employee, mother, father, friend. Just for you personally, I think it's so important. And then sticking to your investment strategy. So I talk to my clients about this all the time. There's a lot of solo investors out there. Emotional investing is expensive. It is expensive to be a panic investor because a lot of times, yesterday, there was not a lot of warning between when the market was down and when it shot up. So you couldn't say, okay, I'm going to invest at the end of the day tomorrow, because you would have missed that spike. So honestly, staying invested, if that is your, strategy right now, sticking to it is super important. And staying diversified. This is just another example of why it is important to be diversified when it comes to asset classes, when it comes to geographic locations, when it comes to, even the different investments you have, how they're treated. Because your retirement account savings, if you are in retirement, might be different. Maybe you treat your Roth differently. That might be the longer term money. Your savings could be invested differently, like a high yield savings versus your taxable brokerage account or your 529 for your kids. The time frame matters. It doesn't all have to be the same, but being diversified is super important. And that doesn't just mean having money in different spots, because if you have money in different custodians in different locations, and your 401k is all in the S&P 500 index and your brokerage account is all in the S&P 500 index, everything is going to be impacted the exact same way, no matter where it is. Another thing you can think about is paying down high interest debt. Interest rates are sticky. And I think that as things get more expensive, if you are still relying on credit cards, you're not paying down debt, and you don't have a plan to free up some cash flow, it's going to be stressful and it's going to be a difficult time to have that. So it's really important, if you can, come up with a plan, start to reduce that high interest debt, be mindful of your spending as you consider taking on more. And, if you are thinking about a major purchase right now, I think you need to not panic again and do it because you're afraid. You don't need to rush out and get a new computer or a new car or anything like that because you're afraid. But if it is part of your plan, now could be a good time to take a look at that, because anything that is already here, anything that's already been manufactured is not going to be impacted. But things that are being manufactured right now, and this is going to include everything really globally, most of the things that we have are not 100% US made, especially electronics and technology. It could be a good time to actually move forward with that plan instead of overthinking it and waiting too long and potentially spending more down the road for something you actually need today. And also, working with a financial planner or professional, I think it can be helpful. And now I'm biased because I am one, and I see the help and I see the impact that it has on my clients when we're able to talk and we're able to discuss these things that are stressing them out and that are coming up when it comes to work and it comes to their budget, when it comes to expenses. It could get rid of some of that overwhelm and really help them start to take positive action in the right direction. I do want to say for those tips, there is a little bit of a difference for people who are close to retirement or approaching retirement. If you're about 5 years out, maybe even 10 years out from retirement, the volatility can hit different. You don't have as much time to wait for this rebound as you're drawing down your assets. So this is where something called sequence of return risk comes in. So if, say, this year your portfolio took a really big hit and you're early in retirement while you're drawing from it, it can reduce how long your money lasts, even if the market recovers later. So one of the things you might think about if you are close to retirement is maybe increasing that emergency fund or that liquid, that stable short-term bond amount, that bucket. And instead of like 3 to 6 months, it might be 1 to 2 years. So maybe that is where you kind of have that more protected early retirement bucket where you can withstand, or even if you keep that amount all the time for those next 2 years, and then you can kind of look further out and keep that money invested that is more for future you. We're planning for like 25, 30-year retirements now for people. So the money has to be working hard. It just does matter when you start pulling it from and what it's invested in. And then keep your withdrawal strategy flexible. So if you're at the required minimum distribution age, you have to take that amount. But if you are under that, you do have flexibility where you take the money from, how much you take out, if you take it out in a lump sum or over, a monthly, like if you can withdraw your money in, a certain strategy, I think that can help you, really be prepared for when the markets recover. And then just, diversifying your income sources. I know that part-time work is not possible for everybody, but for some people, especially if they retire early, they could potentially add income streams in. They could, you can look at your Social Security strategy if you have not turned that on yet. Sometimes it makes sense for people to delay. Sometimes it makes sense for people to take it. It's really a personal thing. But, anytime you can add income sources in, it's going to make the financial plan better. Another thing to think about is concentration risk. So this is what happens when you have too much of your money in one stock, one sector, one strategy. A lot of people will end up with a lot of their employer stock if they went heavy, if they were offered a discount or they worked somewhere for a number of years. And so sometimes if one area or one sector or that particular company struggles, your entire portfolio can suffer. So diversification is really important here. Mixing up your investments across industries, asset classes, geographic locations. If you just have a strategy to sell a certain amount of your company shares and reinvest them in something more diversified, you're always, as you're working, going to have a lot riding on your company's performance. They pay your paycheck, your benefits, everything, plus your equity compensation. So you might want to come up with a strategy. If you wouldn't always dump all that money right back into your company, maybe it's a great company and you want to hold on to some. Sometimes it's a great strategy, but depending on the volume, it might not make sense for everything. So definitely something to work with an advisor on if you have equity compensation or you are starting to have that large concentration, because there's tax issues as well, depending on where the account is held. So really, really important thing to think about. Another thing I want to talk about is really just staying calm during the chaos. So this is something that easier said than done. I think about, a lot of times when I was growing up and things got more expensive, it wasn't like we just had this magical, supply of money that we could tap into. We didn't have an emergency fund. When medication got more expensive, it wasn't just like stockpiling. It was like spreading it out or skipping it is something I saw, that had to happen. And, I was a child at the time, but like, I understand that. So there might be a lot of people who are thinking that like, this is, emotional and it is normal to panic. So I think one of the things that can be really, really helpful if you are stressed is, having a financial plan. It will give you the confidence to weather things like volatility. It will give you that outside of the bottle reading a label perspective, because I'm looking at things from a different perspective, 30 years out, 20 years out, and you're looking at your bank account today. And it can be really hard to picture that if you just keep doing what you're doing, it's going to pay off, because our brain believes what we've seen. We like proof, we like evidence. So we don't have a ton of evidence that things are going to work out in the future. So using those tools and those strategies and kind of, you know, looking at a plan and really trying to figure out ways to keep things on track, even if it means doing exactly what you're doing today and staying the course. The planning can be really helpful. Another thing is limiting the noise. I think it's important to stay informed, but don't let the 24-hour news cycle control your mood. And I'm guilty of this too, watching the futures market before I go to bed and looking at things as soon as I wake up. And so, we're going to see breaking news all the time. Red line on the bottom of the screen, 24/7. And it's not always breaking news. It's not. Some of it is just, entertainment, getting eyes on the screen. We are attracted to things that are standing out, things that scare us. We are more likely to look for fear than the positive stories. And I think that the media knows that. So it's really important to try to stay informed, but not to necessarily let it control our mood, our actions. But just to, try to notice if you maybe need to shut off the notifications for a little while and talk it out. I mean, you don't have to do this alone. I think you can, there's a lot of people, that you could talk to. You could talk to an advisor, you could talk to your family, you could talk to your friends, you could talk to friends on the internet who have similar common goals. You could talk to your coworkers. It's really important for people to be able to express, what's going on in their minds, especially if you're somebody you know, who's learning, who's maybe first starting out, or maybe this is a new experience for you to, maybe you're a new parent, maybe you're new to, thinking about retirement, maybe it hasn't been on your mind. There's people who've gone through these things before, and it can be helpful to kind of have someone to talk to. And also reflect on your goals. And this is something that people do a lot, because they might say, I want to buy a home, I want to retire at 65, but like, what do you really want to do? What motivates you? What are the goals that we could put on the calendar, short term, long term, medium term, things that you want to make sure you do, so you don't look back and say, oh, I wish I did that, or I never got to travel, I never did any of those things, I was so busy. I think it's really important to reflect on these goals, because we have to continue living, like we can't be stuck in like fear or panic. However, if we plan ahead, there's no real reason why we have to put off everything now for the future, or reasons why we shouldn't make some sacrifices today for the future, if it is really important to us to be financially secure, to not have to depend on somebody. So kind of uncovering what those real things are that matter to you, and making sure that you're putting your dollars, putting your energy and attention and effort there, can be really helpful. So, just to wrap it up, I want everyone to understand that there are major global economic issues going on. These tariffs are serious. They're going to impact everybody. It is not just people who have money invested in the market. It is not just big businesses. It's really going to come down to every consumer. And we're going to continue to see how these could raise prices and impact everyone significantly as we get more news and as more things kind of come out of this situation. But also market corrections are normal. We've seen 20 since 1970, and they usually recover within a couple of months. So this isn't new. This isn't new. It's different. It might be new for you. This might be the first time, or if it might be the third time you're going through something like this in a very short amount of time. But it is important to understand that these are normal. And if you're still working or you're nearing retirement, having that financial strategy is really key. It can help you stay resilient. It can help you understand that you've planned for this, that you're ready for this. And that could be really, really critical. And then also, if retirement is around the corner, now might be the time. That might be that red zone where you really focus in Do you need to change anything? What needs to happen? How can you make sure that you're doing everything you need to do to kind of lock down that ultimate goal of being able to be either financially independent, work optional, really important to kind of tweak things because it might be a different plan than when you were just adding money in and working and saving. And then most importantly, mindset matters. Stay healthy, stay informed, and try to remember that your financial health is a long game. If you found this episode helpful, or if you need help creating a financial plan, I'd love to talk to you. You can definitely head over to mistylynch.com and set up a time to chat. And I just want to thank you for tuning in to Demystifying Money. We'll talk to you next week.